just welcome, well, I almost said council member, County Clerk Susan Lamb, who, as you all will remember, we asked the council to change the rules last year when we started having difficulty getting a retiree as a member of the board. And so we were not able to get a retiree. And so I have appointed Susan Lamb, who is a former member of the City Employee Pension Fund Board, so she can just slide right in knowing what's going on. And so I want to welcome you. I believe this is, let's see, Councilmember Curtis, have we had a meeting when you were here? We have, haven't we?
We've had one.
We had one. This is our second one with you. And so anyway, we now have all the positions filled, and that process worked well. I think it's unfortunate we could not find another retiree, but we fixed the issue with the change. So welcome, County Clerk. And so now I believe we do have a quorum. And so our first item on the agenda is the minutes of February 11th, 2025. And the first thing I'll do is ask for a motion to approve.
Meeting's going.
I'm sorry, did someone make a motion?
So moved.
Thank you, Councilmember Savigny. Is there a second? Councilmember Curtis. All right, now, are there any corrections or additions that you all have noted? You should have all received this, I think, by email, correct, Samantha? Nothing? Anything? All right, all those in favor, now you'll need to say and have your face on the view to vote. Please say aye.
Aye.
Aye. Anyone
Aye.
opposed?
Aye.
Okay, very good. Thank you. That passes. And the next item is our quarter expenses. You'll find that on page 6. And that is for your information only. And then we have the letter of transfer for the estimated payroll for April through June. So if you'll take a look at the expenses, and then I'll entertain a motion to approve the transfer letter. Is there a motion?
So moved.
Thank you.
Second.
Councilmember Savigny. Who seconded? Okay.
Susan.
All right. County Clerk Susan. Now, are there questions or comments about the letter? Anything? All right, all those in favor, please say aye. Aye.
Aye.
Anybody else voting? All right, anyone opposed? Okay, that motion passes. And okay, we're glad to see you. You and Charlene, ever faithful. So next on the agenda is our investment review for the previous quarter. And I want to welcome, so David Calvert is with us. I do not see Allison, David, but I see two people I'm not sure I know. Surya and Gabriel.
So a member of my team, Surya, is on the investment committee.
Okay.
Surya, would you like to give an introduction?
Sure, yeah, good morning, everyone. My name is Surya Pispati. I am a member of our multi-asset class investment committee. I'm based here in Philadelphia. I sit within our investment team. My role is that of a director of portfolio analytics and strategy. I lead a team of analysts working on asset allocation work, capital market research, and client communication. Um, Along with my role on the investment committee, I'm also part of our portfolio construction working group and manager review working group. So I'm here to talk about OCIO portfolios in lieu of Lloyd and Allison.
You have a lot of duties. Welcome.
Thank you.
And Mayor, Gabby's in the law department. She's an attorney senior.
Oh, Gabby, I didn't recognize you with your hair pulled back.
Good morning.
Good morning. Of course I know you. Okay, so David, it's you and Surya.
Yes.
So we're ready for our investment review for the previous quarter.
Okay. I believe I'm sharing my screen. Hopefully everyone can see it. I also sent a copy by PDF to all the committee members last night. So as just a simple snapshot of the portfolio, as of March 31st, 2025, the total pension fund is 36,587,424. You'll see that that is a slight decrease from December 31st, 2024, and that was because there was disbursements totaling about $242,769 during the quarter. So there was a small positive number for the overall return, but because of the outgoing disbursement, that's the reason why you're seeing a quarter-over-quarter decrease in the value of the pension fund. Split up across the portfolio is the return-seeking portfolio, which accounts for about $31.4 million, and then the liability defeasing portfolio, which as of March 31st was $5,145,250. The return-seeking portfolio, which we will go into much more detail and Surya is going to talk about, is a 60-40 strategy, which means that there's a 60% allocation to equities, 38% in domestic equities, 21.3% in international equities, and then the remaining 40.5% in fixed income securities. This is a similar chart than what you saw last quarter. The actuary assumptions get updated once a year, so there's no changes to this particular chart. For a performance snapshot perspective, the return-seeking portfolio increased in market value by $66,428, which was a total return of 21 basis points. The benchmark return was 25 basis points, so in line, slight underperformance relative to the underlying benchmark. The liability defeasing portfolio increased in market value by $152,299. As I mentioned before, there was disbursements of $242,769. And fixed income portfolios during the first quarter, so from January to March, performed quite well. And the liability defeasing portfolio had an increase of 2.91% for the period. One tactical change that was made during the quarter was during March, PFM removed the tactical allocation to REITs and increased the emerging markets equity back to policy targets. Surya, do you want to just talk about that change for a brief second?
Sure, I can do that. So going back to last year, we added to REITs within domestic markets and sourced that from the International Equity Fund within your portfolio. When we sourced it from International Equity Fund, we sourced it in a way that we were underweighting emerging markets within the broad International Equity Fund. As the year passed by, what we've seen is that REITs were being very reactive to move in long-term interest rates, and the volatility across long-term interest rates has remained elevated because there were the concerns around inflation not coming down at the pace that was expected were taking hold in the market. When we added REITs, the intention there was that we're expecting stronger economic growth to continue. Labor market looks strong, and we were expecting Fed to cut rates coming into this year. As the year came by, what we had seen is that the inflation did not necessarily come back down, and we saw Fed pause a lot longer than we had expected going back last year. And the third thing that was happening was that the rate volatility was impacting rate performance. Because we lost conviction, or we did not have the same level of conviction that we had in this trade going back to last year, we decided to close that trade and add back to international equity funds, and thereby adding back to emerging markets within the international equity fund in Q1 of this year.
Thank you. From a trailing 12-month basis, the return-seeking portfolio increased in market value by $1.6 million, which was a total return of 5.42%. And then the liability-diffusing portfolio had a total return of 5.26, which resulted in a combined portfolio return of 5.36 for the 12-month period ending March 31st, 2025. Here's the historical returns. We also have a slide later on, but you can see it's like for the trailing 1, 2, and 3-year basis, as we alluded to in prior quarters. We've dug ourselves into a little hole, and we're working, trying to work out of it. Out of the longer term periods, such as the 5-year and the since inception returns, you can see that we are still ahead of the respective benchmark. A general market update, a few things. The U.S. economy, if you just turn on any channel these days, it's very much clouded by tariff uncertainty and political policy uncertainty. The labor market continues to serve as a backbone of the economy. It still continues to have strong job growth. The unemployment rate remains quite low. And inflation information, it's like we're not out of the woods yet because inflation is still running a little bit warmer than the Federal Reserve would like it to be. However, there is some somewhat slow progress towards the Fed's 2% inflation goal. Of course, the tariff impact is kind of throwing everything up in the air. And as we will see in a couple charts, inflation expectations are much higher in 2025 due to the tariffs. The Federal Reserve has kept the federal funds target rate unchanged in a range of 4.25 to 4.50. So fixed income returns are continuing to generate pretty solid returns because of these rates that are much higher than they have been over the last 25 years. And the Federal Reserve's dot plot implies that there might be another 50 basis points of cuts in 2025. However, over the course of the last 4 weeks, the range has increased all the way up to about 4 or 5 cuts for 2025. And as more recently, it's more back to about 3 cuts for 2025. And you will see shortly, it's like there has been a tremendous amount of volatility over the last 4 to 6 weeks in the markets. And that is highlighted with Federal Reserve Chairperson Powell stating that the administration's significant policy changes relating to trade, immigration, fiscal policy, and regulation is creating considerable uncertainty in the markets. Part of that uncertainty is just the large number of executive orders that have been signed by President Trump. For the just first month of his term, you will see that there was over 70 executive orders that were signed. And this is in comparison to presidents dating back to 1981 with Ronald Reagan. And you'll see that the number of executive orders is quite more significant than any other presidents in recent history. Consumer sentiment with all this change has decreased in recent months. It's now at the lowest level since November of 2022. And with the continual press about tariffs, with some headline numbers such as tariffs increasing by up to 145% on Chinese goods, tariff expectations by consumers is that inflation might surge much higher, upwards of 5%. based upon personal estimates. If you recall, on April 2nd, that is when President Trump came out to the Rose Garden and announced Liberation Day, which was basically the imposition of reciprocal tariffs on many of the countries across the world. The immediate reaction after the Liberation Day announcement was sharp volatility in the markets. You'll see here that on April 3rd and April 4th, the S&P 500 was down 4.84% and then 5.97% over those two consecutive days. And then the Wednesday thereafter, there was a temporary pause on tariffs. And basically, tariffs would be reduced to the 10% amount, at least for the next 90 days. And that resulted in the S&P 500 increasing by over 9.5%, one of the largest returns on a daily basis in the history of the stock market. Since then, going on the right-hand side, we've seen another record. If you continue on, there was 9 consecutive days where the S&P 500 index was up. And that goes back to about 20 years where there was a consecutive number of days of up markets. So if you look at your statement as of March 31st versus April 30th, you're probably not going to see much of a change in market value, but throughout the entire month, it was a whirlwind. In fact, I was talking with others and my friends, and I was saying, it's like I was spending about an hour and a half, 2 hours just trying to catch up with all the day's news because there was just a flurry of news that was occurring during the days after Liberation Day. Sorry, anything else to add?
You nailed it. I think, the numbers mask the level of volatility that we've seen during the month. VIX is something that's used as a measure for volatility within the equity markets. Typically, that's the normal range is considered around 20, and that shot up to over 60. That kind of tells you the amount of volatility that was underlying the market movements that we saw during the first 2 weeks of April.
Any questions?
Does anyone have questions so far? All right.
So overall, the tariffs, it's like has a lot of people questioning what's going to happen because on the chart on the right hand side, based upon the announcement on April 2nd, the effective tariff rate would increase from that very low blue line, which was in the neighborhood of maybe 2.5% to 3.5%, up to the light blue circle. So you're going from an effective tariff rate of 2.5% to something greater than 20%. And based upon Federal Reserve staff research, they suggest that every 10% increase in the effective tariff rate, so we're talking about maybe 23% increase, leads to a 0.8% increase in inflation. So maybe anywhere between 1.5% to 2.5% increase in the overall inflation picture. And then the economic impact is that the Fed staff research suggests that a 10% increase in the effective tariff rate leads to a 1.4% decrease in GDP. So this is very much highlighted on the next chart here, where U.S. GDP forecasts were substantially revised lower after the April 2nd Liberation Day announcements. As you can see here, economists on average is expecting much slower growth for 2025, with estimates between 0.5% for the third quarter to 1.4% during the fourth quarter. When I put this together, the estimates were 1%. We just saw the print for GDP last week, and the actual number for the first quarter was contraction of 0.3%. So it was a very significant deviation from economist estimates because you could see the light green bar. No one was projecting a contraction for the first quarter. They thought that we would kind of slip by with slower economic growth, but at least it would be positive. So there was a much sharper reversal. Part of that change was because there's been a lot of volatility related to trade. So many people were expecting that tariffs would be imposed. So manufacturers were importing goods prior to the April 2nd announcement, which resulted in one of the highest trade balance indifferences ever on history. As you can see, trade balance deficits were in the neighborhood of 120 to 140 billion dollars per month. Our overall trade deficit with countries across the world is about $980 billion per year, to just put that in perspective. Core CPI, we continue to see some improvement. However, everyone is kind of guessing on what is going to be the direction going forward with tariffs being rolled in. Even if companies aren't paying tariffs because of the temporary reprieve, companies are getting ahead of themselves and starting to charge higher prices for their products in anticipation of tariffs and other related costs. And as I mentioned, the unemployment rate remains well below its 25-year average of 5.7%. As of March 2025, it was 4.2%. Tomorrow is actually going to be when the Federal Reserve announces its next decision on overnight monetary policy. There's no expectation that the Federal Reserve is going to lower rates at the meeting that starts today and going into tomorrow. But there is quite a bit of uncertainty on when they might start lowering rates, whether or not at the June meeting or a little bit later into the fall. Overall, the last projection they put out, which was in the middle of March, showed 2 decreases in the federal funds target rate for 2025, and then 2 additional decreases in 2026, with the longer term expectations for the federal funds target rate in the range of 3%. We have a positive slope yield curve, but shorter term rates, especially in the 2 to 3 year area, have come down quite considerably, especially in recent weeks with the considerable uncertainty related to tariffs as well as the impact on the stock market. Longer term instruments are trading in a pretty significant range as people are kind of processing what are the long-term expectations for inflation and whether or not the Federal Reserve is going to be able to maintain inflation in check with a significant surcharge on a lot of products across the country. Surya, anything that you would like to highlight on this chart?
Sure, yes. This chart here looks at the different factors that the investment committee is monitoring. And as you can see, there has been a shift downwards in terms of economic growth expectations and financial conditions, given the uncertainty that we've seen even coming into April 2nd. Back in March and back in February, we had tariffs announced on China. We had tariffs announced at sector level, especially on autos. Given that level of uncertainty coming into April, we saw an increase in overall uncertainty around economic outcomes. And with the Liberation Day, that has only increased the range of outcomes that we could possibly see over the course of next 3 to 12 months in terms of economic outcomes and in terms of how the tariff situation might eventually play out. For us, that's reflected in that dark red on the policy political risk. We think that that's the big unknown out there, not knowing how this whole tariff situation is going to play out. But in the near term, what this does is it increases uncertainty, and as a result leads to a pause in terms of corporate spending, corporate hiring, overall business investments, and consumer sentiment, consumer spending. So we think that the longer this uncertainty remains, the more negative impact it would have on overall economic growth. So our view at this point is that we expect economic growth to be much slower this year than last year, and the probability of recession is rising. We're not necessarily calling for a recession yet, but the probability is definitely rising, and it all comes down to how the next few months play out in terms of trade negotiations. But higher uncertainty uncertainty always unnerves markets, and you're seeing that in market performance as well.
Any questions about the markets before we turn into the individual sectors? There's a lot to digest, so.
Does anyone have any questions? All right.
I actually, having the, David, if you wouldn't mind to go back to the prior page, please. Mr. Calvert, sorry, I should have referred to you as Mr. Calvert. I'm curious, the economic growth and the financial conditions are showing the outlook 1 quarter ago with the white dot, but all of the other pieces, since I'm back into this and new to this information, I'm assuming that all of the other factors, because there's not a white dot to show or signify that there's been change from 1 quarter ago, that those are all
Unchanged from the prior
same.
quarter. Yeah.
Okay, all right. I appreciate that clarification. Thank you.
Sure, and I if you're looking at this for the first time, my apologies. I didn't go over the construct of this, but the idea is, what are the different things that we're monitoring as it stands today, and do we think that they would help the risk asset performance? And when I say risk assets, it's equity markets and credit markets. So how are these things placed in the next 6 to 12 months? And would that be conducive to the performance across risk assets? So that's what we're trying to get at. It's trying to put a qualitative overlay on the factors that we look at, knowing fully well that there is interdependency across these factors. None of these exist in vacuum in itself, but these would be the top 9 that rise to the top.
Are there any other questions? All right, thank you.
So I'm going to jump to this slide and then go back to the prior one. But during the first quarter, we actually saw a pretty significant divergence between domestic and international equities. If you recall from prior conversations, domestic equities, especially with the Magnificent Seven, propelled the S&P 500 above all other industry components. However, there was some sluggishness among the Mag 7 firms, and you can see for the quarter to date, so the period ending March 31st, the S&P 500 was actually down by 4.27%. Meanwhile, the EFI index was up by 6.86%. So that's almost an 11% difference between international equities and domestic equities. I bring this attention, and part of the reason why it's always valuable to have diversification, because we were having some clients thinking, it's like, okay, why should we continue to invest in international equities? If you look at a longer term basis, it's like they have been trailing domestic markets. And there were some folks that were saying, it's like, oh, should we eliminate that position? It was a good thing that we did not, because you could see that there was a significant deviation between those markets in just the last 3 months. And then fixed income securities, because interest rates actually decreased during the quarter, that actually helped increase the prices, increase and generate a higher total return. You can see that the Bloomberg U.S. Aggregate Index generated a return of 2.78%. And as we go into the individual portfolio, there was a little bit of credit spread widening, which actually decreases the value of having corporates and other credit-sensitive fixed income securities in the portfolio. So those underperformed. Surya, anything else you might want to highlight on this particular slide?
Yeah, one thing I'll highlight is the weaker dollar that occurred during Q1. And the impact that it has is, for a US-based investor, which is what we are here, When you translate the international equity returns back to US dollar, a weaker dollar tends to have a positive impact. So the numbers that you're seeing under international equity bucket, they have been helped by a weaker US dollar. If you go back a quarter and go back to Q4, these numbers were fairly negative, and a part of that again was dollar appreciating. So the weaker dollar is having an impact in terms of the returns that we're experiencing here as US dollar investors.
And then I'll turn back to the previous slide, our Q2 outlook.
Sure. What you'll see here is that everything's in yellow. And this is reflective of our neutral view coming into this quarter. Our view was that there's so much uncertainty. We don't know how these things are going to play out. So we're better off staying closer to the benchmark. We're better off not taking any big bets in the portfolio because we don't know how all of this uncertainty is going to resolve itself over the course of coming few months. That view changed for us during the month of April. During the month of April, we saw markets sell off a good bit, and then the portfolios drifted away from their benchmark targets. The investment committee got together on April 9th, and we looked at the portfolios and we said that maybe there is merit to be defensive here within the portfolios. What that translates into is that the investment committee voted to have a tactical underweight to US equities and a tactical underweight to international equities, and having a slight overweight to fixed income. When we adopted those targets, though, we did not necessarily go ahead and make trades. Given that there was so much volatility in the market, we did not want to make trades during period of such high volatility. But after the month end, we are rebalancing all the portfolios to our targets. What that means is that for your portfolio, I saw that it shows up as 38 versus 40. We'll get there, but the idea is in places where the portfolio has an overweight to equities relative to our tactical weights, we're trying to rebalance it back so that all the portfolios will reflect a slight underweight to equities and a slight overweight to fixed income. The reason there is that given the uncertainty, this must be the 100th time I've said uncertainty, but given not knowing what's to come here, our earliest stance was let's not do anything. But our current stance is that given that we don't know what's going to happen, we know for sure that we're going to slow down from here. We know for sure that equity markets have more downside baked into them than upside. And why do I say that? Because if you look at the returns for the month of April, they were down about 60 basis points. It does not discount for the fact that earnings estimates for 2025 are coming down, does not discount for the fact that companies are coming out and suspending guidance, and some companies are issuing negative guidance for 2025, does not discount the fact that we still have 10% tariff in place across most of the countries, does not discount the fact that we still have 145% tariff in place with respect to China. I think the market is looking past that and looking forward to trade deals being negotiated. But where we are, we're saying that there is more downside if things don't go as planned. And we are comfortable being defensive because when you see valuations on the slightly expensive side, and when you're seeing that fundamentals are deteriorating a little bit, it's okay to be defensive and it's okay to protect the portfolios than trying to chase performance. As a result, the general view has been to be defensive across portfolios. Any questions on that?
Are there any questions? All right.
And then we'll just highlight a couple components of your actual underlying portfolio. As I mentioned before, there's essentially three sleeves: domestic equity, international equities, and then the fixed income components. The first lines here for the quarter, you will see that the domestic equity piece generate a negative return of 4.86%, slightly underperforming the underlying benchmark, the Russell 3000 benchmark of negative 472. Over the last year, this particular sleeve underperformed the benchmark 545 versus 722. The international equity sleeve outperformed and had a very solid return for the quarter, generating a positive return of 593 versus the underlying benchmark of 523. Over the course of the last year, the international sleeve generated a positive return of 629 versus 609. And then on the next page is the fixed income multi-manager fixed income fund, generating a quarterly return of 249 versus 278 for the benchmark. This is a primary driver of the underperformance of the overall portfolio. But you can see over the longer term, the fixed income sleeve has generated positive alpha with 1-year returns of 528 versus 488 for the benchmark, and even 3-year returns of 110 versus 52 basis points. Underlying each of these is the various investment managers that are deployed. Anyone, one or two area that you might want to highlight?
Sure. On the domestic equity side, Jacobs Levi is a small cap manager. They have a quant model, which means that they're using a systematic quantitative model to outperform their respective benchmark. As a result of that, their model tends to take some bets in the portfolio, and those bets did not necessarily work in their favor, especially when you see sharp movements in the market. It's harder for a quant model to keep track of the market because it's relying on past data, and the data is moving quickly. It's a manager that we're closely watching at this time and are looking to see if we should continue to keep this manager or if we should look for other options. But it's a manager that we're paying close attention to within domestic equity fund. With an international equity fund, I would like to highlight Aristotle International Equity. That's a manager that has underperformed in Q1. This is a manager that is a fundamental manager. So what they do is they're looking for stock ideas across international equity markets, international developed equity markets, and are building a portfolio of about 25 to 30 stocks. It tends to be more concentrated in nature. They have some of the Canadian holdings in their portfolio. Brookfield Asset Management is a Canadian asset manager, which is one of their top holdings. As you all know, Canada was in the news in Q1 due to tariffs, and Canadian markets did sell off a lot more, and that has had a negative impact on their performance. But this is a manager that has delivered alpha over long term, given that they're focused on quality companies that are growing, that are trading at an attractive valuation, and that have a catalyst to bring on this growth in the future. So they're very long-term in focus. They're not necessarily reacting to a short-term tariff-related sell-off. But again, this is another manager that we're closely watching at this time. And then on the fixed income side, we're closely watching the high yield allocations, given that high yield spreads had widened recently and they've come back down. But we're asking ourselves if this is an allocation that we still want to keep in the portfolio or not. And that would be Brandywine Global High Yield and Mackay High Yield Corporate Bond Funds. Those are the dedicated high yield managers in the funds.
That's all the prepared remarks that we had. I'll stop sharing and open the floor for any other questions that members
Okay.
might have.
Thank you both. Let's have questions. Are there questions? First, I feel like you all in managing have been on a roller coaster, a roller coaster ride recently. What questions do you have, board members? I don't see any at all. Okay, Commissioner Hensley.
I think we had talked about, and maybe this is the reason you're joining us today, Surya, that we would come back and talk about underperformance.
Yes, that's our
this-
next. Are
this
we ready to
quarter.
go to that?
Well, and I feel like maybe that this report and this conversation is going to be a little usurped by the fact that we're now going to be in a really crazy time. Maybe a little bit, but I was looking at some of the fund managers in the return seeking portfolio and the allocations, and you had mentioned that you're maybe going to change strategy a little bit, and hedge a little bit as far as taking a little bit more of a defensive posture, and I'm sure we'll get to that. But I was looking at some of the fund managers as far as their performance. And I was wondering if, not in the moment, because I know this isn't something you guys probably have off the cuff, but would it be possible to get some of these that we've had for quite some time, their performance over like over the longer term? We see the 1 year, 2 year, 5 year. It's kind of harder to tell how long. The one that you've mentioned is actually not one that I necessarily would have been concerned about by looking at the numbers that I'm seeing on the page, but you are concerned about that one. And so that kind of made me wonder what you're seeing that I'm not seeing. And I think it's kind of maybe aggregated in those, in that since inception number. And so I was wondering if you could provide us the year by year since the fund manager's inceptions between now and our next meeting, if that would be possible.
Yes, I'm sorry. I'm quite sure we can do that.
Yes,
Thank you.
yeah, we can do that. And you were looking at calendar year performance at the fund level and at the underlying manager level, right?
Yeah, that's just kind of what I was looking at. The Jacob Levy small cap wasn't one that I necessarily would have pulled out as being concerned about in the since inception number, which is kind of how I look at it in the longer term. But that was one that you brought out, so I was just kind of wondering
Yeah.
what you were seeing I wasn't seeing. So
Now that's a great question, though. We'll get you that information, but in terms of how we're thinking, what we've done in these portfolios over the last year and a half is, of course, 2022 was a bad anomaly for us in terms of performance. And so for the last year and a half, we've been really focused on these portfolios. We've been going back to the drawing board and we're saying, do we have the right mix here? Or are they matching in terms of style approach? Are they matching in terms of their holdings, in terms of the bets that they bring to the portfolio? And we've been doing these deeper dives at individual fund level on a constant basis. And as a result of that, you would notice that Juan Nelson was one of the managers in this portfolio that no longer shows up. It has been replaced by Putnam. Nuance was another manager here 2 to 3 years ago, and that no longer shows up here. Jacobs Levi, again, it's a quant strategy, and we're thinking, should we replace that with maybe more fundamental? Should we think about value growth? And these are all the thoughts that we're having internally in terms of how can we make it better, understanding fully well that our clients have had to bear the brunt of poor performance recently. So at each fund level, we are doing those deeper dives. You also see that in terms of the passive allocation. Earlier, we used to have Vanguard Total Stock. We've replaced that with Schwab large cap because we said Vanguard total stock has large cap and small cap. Let's break it down. Let's have large cap passive, which makes a lot more sense because large cap is more efficient. And then let's have more capital out for small cap. Similarly, within international equity, we used to have Vanguard Total International, we used to have iShares Total International as the passive, and we've replaced it with Schwab Developed Markets and Emerging Markets ETF. The idea is let's break it up so that it gives us the levers for when we do those trades, like I was referring to the REIT trade. If we want to source from EM, we don't have to sell out of a manager, but we have the passive to pull from. So what you're not seeing is some of the conversations that we've been
Sure.
having internally with regards to these funds and how to improve their performance and structure. And that should be an ongoing discussion for us. It's not that the performance was bad and as a result we're having these, but if anything, we're having them in more frequency than before.
Okay. The one I was looking at in particular is the Russell 1000. It looks like we're overcoming, since inception, we've got a over 7 point loss, and we've got a couple of years of 18.5% return. So to have, I don't know how many bad years we had in there. If we had 2008, 2007, 8, 9 in there that were, really, really bad, that are offsetting that. And we've had that one for a really, really long time. And, it's kind of hard to gauge. Maybe some of the others are newer and they're not showing that we've had, they've had rough years. So I'm just trying to kind of figure out. That was a really good example, and I appreciate that. But some of the strategy behind some of the ones that I would maybe be a little more concerned about, and some of the ones that you guys have already substituted out and kind of broken apart to have some adjustment ability with, that would just be maybe helpful. And then we can kind of ask a little bit more questions. I think because maybe the intention from our next conversation was to have a subcommittee from here. So
I really like that idea, Erin. What I was just thinking is when you brought up 2007, 8, 9, we haven't had what one might normally think of as normal 10 years. It seems like we've had more years when there's turmoil than not. And I don't know how that compares with a 20-year look, but we've had a lot of abnormal years, haven't we?
I think they stick out.
They do
I think
stick
that-
out, and there have been a lot of them lately. When you do the 7, 8, 9, you do the pandemic, you do the turmoil around that, you do this. I guess they do stick out. But I like your idea.
That was my only.
Okay,
question.
it's a good one. What else, board members? Anything? So if you can, Erin, I think your words were to bring that send that before the next meeting so we could individually take a look at it. Is that your
Yeah,
intention?
sometime since we meet kind of quarterly at sometime the next, month, 2 months, couple of months would be great.
I think our next meeting is end of July 29th. So that would be really
We have
good.
some time.
And who knows by then
Yeah.
what the situation will be.
Indeed.
Right? Anything else? Nothing? Okay. Well, we appreciate very much your presentation. I personally, I haven't really followed day to day because it's too hard from a personal perspective. And what I wish is we would just all settle down and then go forward. I'm living in the Pollyanna world on that because I think the turmoil will go on for a while. So
There are going to be
anyway,
some repercussions.
yes.
I have a few higher education clients and are heavily reliant on the grant funding. And
Mhm.
because of temporary pauses on grants or programs being cut completely, they're actually seeing some significant shortfalls on expected cash flows.
Mm.
So there are things within the executive orders that are going to have repercussions that is going to slowly trickle in, I think, over the next several months.
Mhm.
Um,
All right. Thank you very much, David and Surya. It's nice to meet you. Thank you
Thank
for
you for
being
having me.
here. Yes. Um, your background is a nice, calm looking place. Surya.
It's one of the standard teams backgrounds.
Yes.
Calm. Okay, thank you very much for that. And I will say to the board members, we don't have any other business. You see that our next scheduled meeting is July the 29th. And I'm sure that Samantha will reach out to be sure before that we know we have a quorum. And is there anything else for the good of the whole before we adjourn? No. All right. Well, thank you all for being here, and I'll ask for a motion to adjourn.
Motion to adjourn. Second.
And I saw a second. Thank you. All those in favor say aye. Aye, we are adjourned. Thank you all very much.